In this video, we'll discuss how Warren Buffett made his first $1 million and what you can learn from it to boost your own wealth. Despite his current massive wealth of $100 billion and overseeing a $650 billion company, seeing his early strategies is much more insightful. These early approaches are more applicable since his current methods differ due to managing much larger sums. Exploring how Buffett achieved his first million can provide practical tips for your own financial journey. In 1936, in Omaha, Nebraska, there was a boy named Warren Buffett. He was only 6 years old back then. Even at that young age, he was thinking about being rich. He told his family that he wanted to have $1 million by the time he turned 30. He said if he didn't, he'd even jump off the tallest building in downtown Omaha. This might sound funny, but it showed how serious he was about getting rich. As he grew up, this idea of becoming a millionaire stuck with him. It pushed him to work really hard and make smart decisions about money. It's like a little seed of an idea that started when he was a kid, and it grew and grew into a big tree of success later in his life. One of the important lessons we can learn from Warren Buffett is the importance of compound interest. Buffett uses the analogy of a snowball rolling down a snowy hill to illustrate this concept. Initially small, the snowball grows as it moves down the hill due to the accumulating snow. Similarly, compound interest grows wealth over time. Buffett recognized this early and began his wealth-building journey promptly. At the age of 6, he started selling items like gum, Coca-Cola, and magazine subscriptions door to door. His approach was straightforward, purchasing a pack of 6 items for 25 cents and selling them for 30 cents, earning a small profit of less than a penny per item. While this initial door-to-door venture was a stepping stone, it taught Buffett valuable lessons. The first lesson was about the importance of margins in business, the difference between buying and selling prices. His door-to-door sales had low margins, yielding less than a cent profit per item. To achieve his goal of making $1 million, he would have had to sell well over 100 million cans of Coca-Cola. This was a tough feat for a single young individual, considering that Omaha's entire population in 1940 was only 220,000. Selling 455 cans of Coca-Cola to each person in Omaha would have been a monumental challenge for one young entrepreneur. Another lesson that Buffett learned during his early ventures is the importance of making a business scalable. He realized the importance of creating a business that could make money without requiring his constant involvement. He wanted to find a way to make money without working all the time. This led him to his first investment in the stock market when he was only 11 years old. He had saved up $120, which is like having around $2,300 today. He put most of it into a single stock called City Services Preferred. But here's where it gets a bit tricky. Instead of the stock going up and making him rich, it went down. Every day he saw his money getting smaller. To make things even more stressful, he had talked his sister into investing too, and she wasn't too happy about losing money. She'd remind him of it quite a bit. After a while, the stock started going up again. Warren, maybe tired of the stress, sold his shares and made a small profit. But here's the thing. After he sold, the stock's price shot up even higher. He kinda sold it too early. This experience taught him a bunch about investing. And if you've ever felt bad about selling a stock too soon, just remember, even someone like Warren Buffett made that mistake when he was starting out. Let's move ahead to when Buffett was 14 years old. His money had grown to $1,000, which would be like having around $15,000 nowadays. Around this time, he stumbled upon a book that really changed things for him. He'd read lots of books about business and investing from the library in Omaha, but there was one book that stood out. The title was 1,000 Ways to Make $1,000. A pretty smart title, I must say. As you might guess from the title, the book listed 1,000 different ways a person could make $1,000. Remember how Buffett wanted to reach that $1 million goal? Well, it probably wasn't lost on him that if you multiplied those 1,000 ways by $1,000, you get $1 million. If this book was legit, it seemed like the perfect guide to help Buffett reach his first million. This book came out in 1936 and had a really important message. It had never been easier for someone with a little bit of money to start their own business. All they needed was to take that first step. Now, keep in mind this book was written over 80 years ago, way before the internet, software, and social media took over. Buffett really took the ideas from 1,000 Ways to Make $1,000 to heart and used them to come up with more business ideas. These small businesses kept him moving closer to his goal of making $1 million. The following year, when he was 15, Warren's money doubled from what he had the previous year. He had $2,000 now, which would be like having around $30,000 today. And guess what? At just 15 years old, he did something pretty big. He bought an entire 40-acre farm in Nebraska for $1,200. He put most of his money, about 60%, into this one investment. Now, Buffett wasn't exactly a fan of hard physical work, so he teamed up with a local farmer. He offered the land, and the farmer did all the heavy lifting. Then they shared the money they made. At just 15, Buffett knew something that many people never really get: how powerful it is to earn money without actively working for it. We've got to admit, it's a bit cringe to say passive income nowadays, thanks to all those online gurus. But when young Buffett bought that farm, it gave him income without needing him to keep working for it. When Warren was around 15, he made $1,000 from his little businesses, and his farm brought in $400 more. This made his total earnings go up by 40% without him doing extra work. This was a big deal in how he was building his wealth. Before, he had to work for his money, but now his money was starting to work for him, kind of like a helper. Now let's talk about Berkshire Hathaway, the big company he runs. Imagine he spends a huge amount, like $1 billion, to buy a business, but he doesn't have to run it himself. He gets money from it because he owns it. Then he uses that money to buy even more businesses. And that's not all. Those businesses also send him money. It's like a wheel that keeps turning faster and faster. This is how he turned Berkshire Hathaway into a massive company. But here's the deal. You need money to start this wheel turning. And this is where young Warren comes back into the story. At 16, he was making $175 every month delivering newspapers. Just so you know, most families made about $275 a month back then. So, as a high school student, he was making almost 2/3 of what a whole family made. But things weren't always super great. When he was younger, he worked at his grandfather's store and got paid only $2 for 10 hours of work. That's like 20 cents an hour. This showed him that working for yourself could be better. When he delivered newspapers, he got paid for each one he delivered, not just for the hours he worked. So, he found ways to deliver more papers and make more money. If he had stuck with his grandfather's store, he wouldn't have earned nearly as much during his teen years. Around the same time, young Buffett kicked off what would be one of his most impressive business successes percentage-wise. He turned a $25 starting investment into an amazing $1,200 in just a couple of years. How did he do it? With pinball machines. It's kind of a great story. He'd buy old broken pinball machines for $25, fix them up to look new, and then put them in local barber shops. He'd offer the shop owner a deal. They'd split the profits. This way, the shop got extra money and Buffett got a cool spot for his pinball machine, plus a bunch of customers. It was a hit right from the start. He used his profits to buy more machines and soon had a bunch all around the town. And here's the magic part. These machines kept making money for him, whether he was at school or delivering newspapers. Before he graduated high school, he sold the pinball business for $1,200. Quite a jump from his original $25 investment. This was probably his best investment ever when you think about how much he made in percentage terms. Now, fast forward a bit to when Warren was 19. His money had grown to $9,000, which would be around $100,000 today. This was a big moment because he shifted from being a small-time entrepreneur to a serious investor. What changed things? He came across a book called The Intelligent Investor by Ben Graham. This book was like a roadmap for value investing, which is all about finding stocks that are undervalued. It totally clicked with Warren. He liked the book so much that he wrote a letter to Ben Graham, who was a professor. The letter was like, "Hey, your book is awesome. I thought you were no longer around, but now that I know you are, I'd love to learn from you." And guess what? He got admitted to Columbia University, where Ben Graham taught. This was the real start of Warren's journey as an investor. Warren was an A+ student in Ben Graham's class and practically begged to work at his investment firm. He was really persistent and even offered to work for free. It took a while, but he eventually got hired as an analyst. When he moved back to New York City at 24, his star was shining bright. He earned $1,000 a month, but his smart investments earned him way more. At that time, Warren and Ben Graham's fund didn't go for well-known big companies. They invested in smaller, less-known companies, sometimes even those that were struggling. These companies were cheap, like buying a cigar butt that had one last puff in it. Many of these stocks traded for less than what the company's stuff was worth. For example, imagine a company that made horseshoes when cars became popular. They'd probably go out of business, but their stuff was still worth something. This was Warren's world during the 1950s. Even though Warren was raking in a lot of money through his various ventures, the real reason he was able to grow his wealth so rapidly was that he didn't just spend that money recklessly. Remember the lesson we talked about earlier? He used that money to buy things that would make him even more money. It's like he turned on a money-making machine. This smart move set in motion a kind of cycle. He'd make money, and instead of spending it all, he'd use it to buy assets that would keep making more money for him. It's kind of like a flywheel that keeps getting faster and faster. The more he put into this cycle, the more money he'd make and the more he'd be able to buy more assets. This way, his wealth kept growing and growing. It's a bit like the snowball we talked about earlier. As it rolls, it picks up more snow and gets bigger and faster. That's how Warren's wealth-building flywheel worked. Conclusion: Warren Buffett's golden rule is famously summed up in his own words. Rule number 1, never lose money. Rule number 2, never forget rule number 1. He consistently adhered to and practiced this rule throughout his investment career. This simple and powerful principle underscores Buffett's emphasis on preserving capital and avoiding significant losses as a key strategy for successful investing. If you enjoyed the video, don't forget to like and subscribe to the channel. Our goal is to improve your investing skills by examining the strategies of the world's top investors. Thank you, everyone. See you in next video.